Hello again, everyone. It is 8 o'clock a.m. Chicago time on Wednesday, September 6th, 2023. I'm John Kosar from Asbury Research, and this is your Daily 5. These are currently my 5 most important charts, data series, in Asbury Research quantitative models that I believe are the most important to be aware of and potentially the most influential to U.S. stock market direction over the next several weeks to several months, potentially stretching through the end of this year. Let's begin with a brief recap of our previous August 8th Your Daily 5. We said that our Asbury 6 risk management model shifted to negative on August the 4th from positive on May the 18th. SPX subsequently declined by 3% into the August 18th low, testing and holding the 43.25 support level that we identified during that particular Your Daily 5 on August the 8th. We also said that our SEAF model, SEAF is an acronym for sector ETF asset flows. Our SEAF model was overweight the energy sector, which has subsequently risen by 5%, while outperforming the S&P 500 by 6%. Now let's look ahead into the month of September and follow the money. Number one, the S&P 500 testing formidable resistance at 46.37. So here we have the S&P 500 daily from 2022 on, and the most important part of the chart is this little window right here, bordered by 46.37 up above the market. That's the March 2022 peak that we tested and held back at the end of July. And then 43.25 is that level that I told you we pointed out here last month. Pretty formidable support from the August 16th high of last year. In the middle, we've got the 50-day moving average. That's a minor trend proxy. So the fact that we've been able to eke back up above the 50-day moving average at the end of last week is a minor bullish indication. It sets up another possible test of 46.37. But until we get above 46.37, there's still, it's going to take a lot of effort for the market to get through there. If it does, I think we've got an opportunity to get up to 4,800, which is our longer-term outlook for the S&P 500 that we think we could see by the end of this year. But 46.37 is pretty firm here up above, 43.25 underneath. So watch the market's movement around the 50-day moving average. After getting up above it, if it can't hold it and rolls back down, we'll be looking at other indications like the VIX and like our Asbury 6, which we're going to talk about in just a moment, to see if there's some internal weakness there too that's telling us that we could have another test of the 4,300 area. Major support and the major uptrend right now stays intact above 41.95 to 41.63. So bigger picture, even if we do have a correction here, again, this is a seasonally weak time for the market, as long as we stay up above 41.95 to 41.63, the October major uptrend from last year is still intact. And that represents the converging of the February 2nd high, the trend line from the October 13th low from last year, and the 200-day moving average. Number two, market internals. Asbury 6 turned positive on August the 30th. So when I was with you last on August the 8th, we had mentioned that the Asbury 6 had turned to negative on August the 4th. The Asbury 6 are 6 tactical metrics that we have put together kind of like a team to let us know day to day what the internal health of the stock market is. You can't really look at the S&P 500 anymore and like volume like you used to in the old days, because there's too much day-to-day volatility. There's a lot of computerized trading during the day. Some people estimate that it's 80% of the daily volume. So we built this metric so we don't get faked out by a 1 or a 2 day sharp move down in the market that throws us off of our long position and then forces it to go back in the market and buy it higher. This kind of is a lie detector for the market for us. There are 6 metrics here, and only one of them directly has to do with the S&P 5 or with the S&P 500. That's the rate of change of the S&P 500 up here on top. Otherwise, we have relative performance, investor asset flows, corporate bond spreads, trading volume, and market breadth. That keeps us on the right side of the market. So we had a lot of choppy trading here, as everybody knows, in the S&P 500 during the first half of the year, more towards the front end. But once we came out of that, we had a positive signal in the Asbury 6 on May the 18th. On August 4th, it went back to negative. On August 30th, which is just a couple of days ago, it turned back to positive. So right now, the internal health of the market is good. It is conducive to higher prices. 4 or more of these metrics in one direction or the other indicates a directional status for the model. So right now, there are 5 of 6 are green. So the Asbury 6, as it stands right now, is positive, indicating that the day-to-day internal health of the market is good. Number 3, sector rotation. The SEAF model that we mentioned a little bit earlier follows the money in market sectors. So the SEAF model has been in existence for, 6 or 7 years. I built the SEAF model when sector rotation started to speed up. It used to be that sectors would rotate and you might get a quarter or two out of a rotation. That is no longer the case. The average sector rotation anecdotally is probably 6 to 8 weeks. So if you don't catch those trends very early on and get out of them near the peak, it leaves you with less in the middle to make money with. So I built a model that instead of watching for the relative performance on the chart, it measures the money that's moving around the 11 sector spiders in 3 different time frames: in trading, in tactical, and strategic. And then we look for trends that go across the various time frames. So we've come up with a scoring system. The ones that have the best flows into the sector, inflows, are rated the highest. So through the end of last week, the ones with the best positive inflows were number 1, technology, and number 2, consumer discretionary, XLY. The ones with the biggest outflows, or the most aggressive outflows, were consumer staples and healthcare. So then what we do is we add up these scores across the 3 different time frames, and any scores from 3 to 15 are favored. So you can see the top 3 now is communication services, technology, and consumer discretionary. The bottom 3 are healthcare, utilities, and consumer staples. So simply stated, you can say the money is going into the top 3, coming out of the bottom 3, and the ones in the middle here, neutral, are the ones with a score of 16 to 24. So right now, this is where we are looking for value. Why? Simply because that's where the money is going. Over the past 12 quarters, the SEAF model has outperformed the S&P in 9 of them. It does a very good job of keeping us in the places where the money is going. And when the money leaves, we leave right along with it and look for the next opportunity. So look for those 3 in the upcoming weeks to possibly outperform. As long as the money stays there, those sectors are going to outperform. Number 4, investor sentiment. Least bearish extremes warn of a market top. So we've got a lot of good stuff going on in the market, right? We're in a major uptrend. The Asbury 6 is positive. We see technology. There's some money, according to SEAF, that's going pretty aggressively going into technology. Those are all good things. So now for some bad news of sorts. This is the investors' intelligence data. Asbury Research is actually one of the inputs into their data, and I've been looking at it for years. It tells me where the extremes in the trend might be. So what you see here is the percent bears. There are several different aspects to II, so this is one of them. So the percentage bears right now, between 16 and 14%, I've highlighted in a red line, both horizontal and vertically. And you can see that most of these have identified the area where you might find a top. March 2011, we see here, March 2015, January of 2018, Nove of 2019 was a little bit early, but it caught the move going into the COVID bottom. July of 2021, again, this one was early. This is not a timing tool. It's a strategic tool to tell you when you might be at the top of the current move. And the current move is off of the October bottom, which is right here. I'm pointing to it. And you can see as of the end of July, this particular metric is turning back up. What does that tell us? It tells us that somewhere in here, perhaps somewhere near that peak, the resistance level at 46.37 might be an important peak for the stock market. But until the Asbury 6 turns to negative, we're not biting on that. It's too early. We need to see those internals start to turn lower first. Finally, number 5 here, the wild card. 10-year yields are testing a 15-year benchmark high. I think this is the most important chart that I'm going to show you today. And there is not a tight linear correlation between bond yields and the stock market, but big picture, they're very related to each other. Let me show you what I'm talking about. Back in June of 2008, we had a peak of 4.25% on the yield of the 10-year. We tested that in October of 2022. That coincided with the big bottom that we had in October of last year. So as yields got to that old level and started to back off, that gave a breath of fresh air to the stock market, and it was kind of like the liftoff, you know, the retro rockets that were getting, you know, the market to come off of those that important support level at S&P 500, 3,600. Look where we are again. As of August the 22nd, we're right there at 425. Here's the kicker on this. If we go through 425, we don't have another resistance level here that I can see until we get to 523. And that's the peak. We had a couple of peaks a little bit earlier in the 2000s. June of 2006 was the main one here. So if we get through 425, I think we could see a relatively fast move to 523. If that happens, I think it's going to put a lot of downward pressure on the stock market, and that 46.37 level that I showed you in the first chart is going to be a lot more important. It might be a turning point for the market to go down. The flip side of that is if we hold here and we can get back down under 4%, I think the next level might be 376 in yield, which is a 52-week moving average. So if we can hold 425 in yield as a resistance level and yields come down from there, it's going to help the market go higher, and we can see a breakout higher from 46.37 resistance in the S&P. The flip side of that is if we start seeing yields up in the 430, 435 area, that's a warning signal for the stock market, and we could have a pretty nasty move down as a result of as a result of that. So again, yields higher than 425, bearish for the stock market. Yields backing off and getting back under 4% area, positive for the market. That would suggest to me that we've got an upcoming breakout of that overhead resistance level at 46.37 in the S&P 500. So there it is. There are my 5 most important influential market metrics to watch according to Asbury Research's data-driven approach to stock market investing. You could get a copy of this PDF from this presentation by contacting us via the contact tab at asburyresearch.com. If you like my approach to investing, you can get more research and podcasts like this one by visiting Asbury Research's YouTube channel and subscribing. Thanks for watching. I'll be back with another one of these in October. Have a good month.